All right, our last session of the day will be on high-frequency trading. It's going to be moderated by Peter Kolm, who is heavily involved with the IAFE, is currently at Courant Institute, and with that, I will hand it over to him. We'll have a 1-hour session, and then at 5:30, we will break for the end of the day with a cocktail reception outside. Thank you.
Thank you. Thank you for those words, David. So I have some good news and some bad news. The good news are we're going to do the high-frequency trading panel. Bad news are that this is the only remaining panel before we go into the cocktails and the refreshments. So with that lead-in, let us get started. High-frequency trading is, I think, one of the topics that has received tremendous attention and interest over the last year and a half or so in the media. To that extent that people now talk about high-frequency trading even on the streets. It's a controversial topic because most laymen do not necessarily understand what is meant by high-frequency trading. Here in this room, we have a tremendous gathered expertise. So a lot of what we will be talking about today, I think, will be seen as maybe preaching a little bit to the choir. But we hope that we'll be able to highlight and maybe bring to your attention some things that you may not have thought about before, maybe address some of the newer issues together with this distinguished panel. So with that lead-in, I'm going to start here by introducing on my right, we have Eric Hess from Direct Edge, Ron Fischler from Pragma, and James Angel from Georgetown University on the far right. The format of this panel will be sort of a standard format. We'll have each of the panelists give a little bit of an introduction, talk about something that's on their topic. Speak up, please. The microphone. Your microphone's not on.
Oh, the microphone. Here we go. Now it's on. That even fooled me. Okay. And then after that, we'll move into some directed questions. I'll ask the panel some questions, and towards the end, we'll give everyone here an opportunity, or at least some of you an opportunity, to ask questions as well. So with those words, Eric, would you like to start?
Sure. Is this on? Yeah, it's on. So first of all, I'm the general counsel of Direct Edge. We are the third largest equities market in the United States, perhaps in the world. We have about 10 to 12% of total volume in the U.S. equities market. NYSE has about 27, NASDAQ has about 18 to 20, so that puts us a solid third. A lot of our discussion today is going to surround what happened on May 6th and the infamous flash crash, which was a pivotal moment in market structure and may have a lot of implications for our markets as they go forward, as regulators and politicians adjust. Within about 6 hours of the flash crash on May 6th, I was engaged in a arduous data gathering exercise at the behest of the SEC. That weekend, I was pestered with calls from senator aides. Monday morning, I had to go down to D.C., meet with various chairmen of the SEC, CFTC, Secretary Geithner, meet with Kent Jorsky, who headed up the House of Representatives hearing with respect to the flash crash, speak to various members on the Senate Banking, Finance, and Urban Affairs Committee. Needless to say, this was a scene I'd never seen. That Monday following the flash crash, as we went from building to building in the Capitol, we were hounded by reporters. You know, I had SEC commissioners calling me on my cell phone, asking me to call them back directly. It was intense, to say the least. And I say this because it gives you a sense of sort of some of the hysteria, if you will, that surrounded this event and still kind of surrounds this event. What was kind of comical about the whole thing was the equity market structure release, which was the SEC sort of, I guess, seminal data or concept gathering exercise on where the market should go, right? It talked about what do we do about high frequency trading? What do we do about undisplayed liquidity? What kind of metrics do we need in the market? How's the market doing? And respondent after respondent said, the market's doing great. Don't touch it. Fantastic. Then May 6th happened. Right after the comment period closed, May 6th happened. Now all of a sudden everybody's saying, well, it's doing fine, but. And now it's actually changed the prism through which we look at regulation going forward. You know, for now, all the talk about non-displayed liquidity, and I'm going to assume some knowledge of some of what goes on in the market, meaning trading off exchange, a lot of that's fallen a little bit to the side for now. And now the talk is about trading halts, clearly erroneous trades, high-frequency trading again, but in a different context. How long should a quote be out there? Right? Should there be market maker type obligations imposed on high frequency traders? Nobody asks for what, but should it be imposed? Should we make people be at the inside price? So, you know, I've been working with the exchanges, being the general counsel of an exchange, since May 6th. It's dominated a lot of time that I probably would have spent elsewhere. But there are basically three main mandates that the exchanges themselves have been given, working as a group. Single stock circuit breakers, the trading pause, clearly erroneous trades, and market-wide circuit breakers. The mandate for NASDAQ is also to figure out stub quotes and why Accenture ended up trading at a penny. Basically, I think the tactic is maybe start to look at whether a two-sided requirement for a market is a proper requirement. And these are all being done on a pilot basis, meaning we're supposed to study them, because we sure haven't spent a lot of time studying them going in. It's like May 6th happened, it's like we need this, we need that, we need this. Why? Investor confidence. Oh, okay. Data? No. Investor confidence. We're not talking about data, we're talking about a subjective view of what the market should be. So what are we doing? What have we done? What are we doing? So circuit breakers is something that we all sort of went to because we used it for the short sale circuit breakers that are going to be in effect on November 10th. For those of you that aren't familiar, basically after I guess a couple of years or a 1 year period under the short sale uptick rule, where we took in tons of data across a year and studied it extensively, we all decided that wasn't good enough because investor confidence was at stake. So we reversed our course and we turned around and re-examined the short sale rule again and decided to impose it, but this time with the circuit breaker concept. So under the short sale rule, 10% from the prior close results in basically a short sale upbid requirement for 2 days on a stock-by-stock basis. And in that case, the SIP, or the information processor, will be disseminating the notification of a 10% drop in that security for the primary listing market. Halts is something we also have experience with. We have it for news, we have it for changes in the Dow Jones. So what do we have for single stock circuit breakers today? Well, with a flurry of rule filings by the exchanges and a extremely abbreviated comment period, we have a 10% movement on any S&P 500 stock within a 5-minute period triggers a 5-minute halt. I'll tell you that I was at the meeting where we were kicking around these numbers, and I was pushing hard for, it was at the time there were suggestions, and I don't want to say who, but that we should do 3 to 5% trigger, and maybe up to 10 for certain stocks. I thought that was a little ridiculous. I pushed as a compromise to just push it for 10 across the board, and I wanted the halt to be a pure 2 minutes or less so that people wouldn't try to trade around it, because on the CME, a halt's for 5 seconds, and they say that was enough to correct the market. But there's a lot of controversy. People are uncomfortable with something so short, so we settled at 5 minutes. That's for the S&P 500. immediately after we did the filing, there were now meetings to say we have to expand it again. What about the ETFs? And slowly but surely, this small group of ETFs expanded to virtually almost all ETFs. That's to come. And also the Russell 1000. So the S&P 500 is going to be expanded, right? So the 10% drop that triggers a halt is going to be expanded to the Russell 1000. And next, all stocks, across the board. I won't, since I don't have the time, I won't get into some of the bizarre conversations we've had surrounding this, people suggesting that maybe we should just roll out the 10% to all stocks. I, again, had to raise my hand and say, but what about the liquidity characteristics? Does it make sense to do 10% across all stocks? The S&P 500, by the way, is not very similar to all stocks. Just, that was my opinion. Basically, today, all the exchanges filed clearly erroneous. The clearly erroneous rule is supposed to provide some certitude when a stock moves by a certain amount that people can basically, we call it a multi-stock event. 20 or more stocks within a 5-minute period. If there's an event that affects all of them, we call that a multi-stock event, and that gives a 30% breakpoint. So 30% away from the reference price, it's broken. No more exchanges determining what level it should be broken at. Some of this is a little troubling because it does sort of has bizarre incentives for market makers in the market. If I think that I'm going to engage in a trade and it might result in it being broken and I have a hedge on the other side, I might start to rethink whether or not I want to undertake that risk. And lastly, market-wide. I mean, today we have basically 10%, 20%, 30% breakers on the Dow. So if the Dow were to drop 10% below the prior days, it would basically be about an hour, 30 minutes after 2 p.m. If it was dropped 20%, it'd be a 2-hour halt, an hour after 1 p.m. And then if it's 30%, they just basically shut down for the day. I think there's going to be a movement to try to bring those percentages in. So how am I doing on time? I'm past it. So I'm going to, with that, so those are basically the 3 areas that are being heavily focused on now. Clearly erroneous is out. You're going to see, before we hit the market-wide, you're going to see an expansion of that list for the single stock circuit breakers, and then we'll do market-wide, and then there's also talk about looking at limit up, limit down, which is an entirely new ball of wax. So with that, I will turn it over to Eran.
Thank you. I want to address 2 topics that recently had a lot of bad publicity, high-frequency trading and dark pool. And I want to attack each topic separately, and then I will connect them. So first of all, when we talk about high-frequency trading, which is the topic of this panel, we are actually talking about an umbrella of strategies. And all these strategies are very different from each other, and each one of them has to be looked and examined separately, what it does, how it does, and is it good. So let's look at them for a second. So under the high-frequency trading umbrella, there are market makers, Getco, Knight, Citadel, all these guys. Basically, they provide a service to the market. They bridge short-term liquidity demands of investor, and at the process of bridging this liquidity demand, they are capturing bid-ask spread. So basically, to some extent, they are the modern-day specialists. They bridge liquidity demand, they get bid-ask spread out of it, they take risks, they get inventory, something might go bad, they get reward, the bid-ask spreads. It's a dual risk-reward that we're all familiar and comfortable with. Nothing bad with them. They provide a service to the market. Another class of high-frequency trading is algorithmic trading, all the things that agency algorithmic trading for the buy-side traders. All these guys employ the same tactics and the same strategies as market makers, usually only one-sided, but still they trade very fast, they automatic, but they provide a service to the market. They reduce shortfall, and this is something which is good to the investor. So the first class, the market maker, provide a service bridging liquidity. The second class, reduce shortfall. Both of them are pretty good to the market. There is a smaller group of high-frequency trading, and we all heard about the word like front-running or something similar. Those high-frequency trading shops, what they do is they go over public data. It could be the tape, it could be other type of data. And from that data, they basically try to estimate the direction of the market. There is information leakage in the process, inherent in the process of trading. And what they do, they take bets on these changes. They see something happen on the tape, and from that they know market might go up, and they take bet on it. But there is no big difference between this guy and an army of 300 day traders sits in another shop that's doing it manually. Both of them look at the tape. Both of them infer direction from the tape. Both of them take bets on it. Some of them losing money, some of them making money. But overall, this is something that do not bring any utility to investor. It's something that exists now, and we call it high-frequency trading, but it also existed 10 years ago where there were shop with army of day trader that did the same thing. The only difference, this group automated what 300 day trader did. Finally, and I think most importantly, there are the group that engage in what we call predatory trading. This is where we start to talk about the gray area, people who are doing quote flashing, people who are doing paint taping. Those things are on the gray area to completely illegal, and it's actually the regulator that needs to enforce its rule against this guy that actually serve a disutility to investor. They front run, there is gaming that we will talk about later, and information leakage, all these things, but those guys use tools that either are on the gray area or actually should be banned or actually quite outright illegal. So between all these four groups, three of them actually, at least two of them provide a utility to the investor. One of them is something that exists for many years. The only difference is now it's being automated, and one of them is something which is predatory. I consider it to some extent illegal. But overall, the majority is concentrated on the first two, market makers and algorithmic trading. This is the majority of the high-frequency trading. And overall, this development in market microstructure actually did quite well for investor. Spreads are narrower, there is a lot of liquidity. So overall, they actually bring something very good to the market. Liquidity, narrow spread, it's cheaper to execute today than 10 years ago. I don't know any one of you remember 10 years ago when the spread was 1.8 or 1.16. People forgot that today is like a cent or less. So overall high frequency, it's actually, the majority of it is very beneficial, but there is a flip side to this statement. There is actually a large group of investors that do not need the implicit service that high frequency trading provides. Those are patient traders, people who do not have a demand to immediate liquidity. They are willing to wait 3 minutes until liquidity arrives. And those guys these days have a lot of trouble to basically opt out from the service that the high-frequency trader provide, because high-frequency are always first on the queue in the limit book, and they're always second, and therefore they are now exposed to more adverse selection. So there is a trade-off. High-frequency bring a lot to the market. On the other hand, there are a group of investors that could not opt out from interacting with this guy and suffer some losses. And this is actually what brings me to the dark pool, because dark pool were actually generated to exactly address this issue and provide to this other group of investors, the more patient guys, an environment to actually play with each other, to trade with each other, and basically avoid trading with this high-frequency trader. So over the news, there was a lot about dark pool being and venues that basically distort the price discovery process. And I have to disagree with that. Dark pools are price takers. They are not price creator in any way, shape, or form. All the trades are inside the NBBO, which is published by open exchanges. They know it out of a sudden. There is a trade in the dark pool that is outside of the quote, and then the whole market reacts. Usually it is exactly in the mid. Two people come to dark pool, they trade with each other at the mid price, and really what happened, instead of both of them crossing the spread and trading with high-frequency trader that post dual-sided limits, they trade with each other directly, save half of the spread, and basically traded with each other and canceled the information. One was buying, one was selling. There was no information. It was simply canceled out. So in that respect, dark pool is very important to remember is a price taker, not price provider, and therefore it does not distort the price discovery process. Now, having said that, there is one caveat, which is the IOI, which was again in the news all around in the last couple of months. And actually, I have to agree with everything that have been said on the IOI. They do distort price discovery, they do leak information, were unfair. However, one have to remember, although the SEC planned to ban them, in the actual market, and we're connected to more than 30 plus dark pool, this use of IOI almost disappeared. Because like about a year ago or a year and a half ago, the smarter ones already understood that IOI basically create huge amount of information leakage, huge amount of gaming. They went to every destination and told them, don't IOI my order. And by this time, the SEC actually reminder late last year to suggest to ban the IOI. Hardly no dark pool used them, very little used them, and if they used, you could always opt out. So I'm accessing all the dark pools, and my orders are not IOI'd in any way, shape, or form. I have a full control on it. So in that respect, you have to give the market the credit to correct itself and regulate itself, and this is what happened. People understood information leakage, people corrected it, engaged with talk with their dark pools, and actually this IOI business almost disappeared. So in that respect, remained only with the benefit of dark pool, which is allowing to basically trader meet each other. Another very important, and this is something that it's a recent trend in the market, is a lot of buy-side trader, big institutional fund, are looking for dark pools that are really, really big minimum sizes, 200,000 shares. There are a few of them now. And basically, in that case, this is exactly what I described earlier. What they really want is avoid a high-frequency trader. They don't want to cross the spread with one-day ADV. They want some very, very safe environment where they know who they're playing with. They're only buy-side traders, and they want to mate and cross very large quantities exactly in order to avoid the high-frequency tax that you incur if you actually go to the open market and try to trade their one ADV. So dark pool actually provide a lot of benefits. So it's a cheaper execution. You don't have to pay 30 mils for taking liquidity. You save the spread. You don't have to cross the spread. You basically split the benefit with your counterpart, which is very fair. So all in all, dark pools provide a lot of benefit to the market, and I think the SEC should not touch them. They're working quite well. Now, there is one thing that everyone says, there is a lot of predatory trading in dark pool. The answer is yes, there is a lot of predatory trading in dark pool, but there is also a lot of predatory trading in the open market. It's not just confined to dark pool. Basically, the second two people that I described, people who try to front run you and people who engage in predatory trading, dark pool is not the only place that they're using. They're using the open market as well. So basically, when you trade, you have no choice but to use things like anti-gaming or algorithms that understand all these games and all this predatory trading and avoid them via randomization, via hidden order, via basically price dynamic. There are many ways to do that, and you should employ it across the board to your trading in order to avoid day trader or high-frequency trader that front run or predatory trading. It's not something that it's just confined. We will basically start to regulate dark pool and all this predatory trading will disappear. It's not going to happen. So basically, we're going to live for a very long time with this anti-gaming and that everyone will need to use in order to avoid predatory trading both in dark pool and in open market. So those are the two topics that I want to say. At least there was a lot of bad publicity, and at least I hope I convince you that there are some good things in them. And in that I will...
Thank you. First of all, it's always good to know the audience. How many high-frequency traders are here? Okay, I see a few. How many predatory traders are here? Okay, one in back, honest. This is all off the record, so you can be honest here. How many of you think that high-frequency traders are blood-sucking vipers who are a scourge on our capital markets? Wow, rational people. Where I hang out in the banks of the Potomac, there are a large number of people who hold that view, and it's kind of scary. But anyways, as was mentioned, high-frequency trading has really bubbled into attention over the last year, and especially after May 6th, the so-called flash crash. And that indeed has been a watershed moment, but it's really a widely misunderstood day. You know, a lot of people have been looking for a smoking gun, but there's no smoking gun for May 6th. What we find are a lot of smoking computers. In that, my read on what happened on May 6th is that our market network could not keep up with the volume of information coursing through the pipes. very similar to the crash of '87, when the printers on the New York Stock Exchange could not keep up with the volume of orders coming in, or the telephone system at NASDAQ Market Makers was giving people busy signals. Or the crash of '62 or the crash of '29. You go back to previous market glitches, events, corrections, crashes, whatever, and guess what? Our market network is a system. It's a highly complex system, and it has a capacity limit. And when you start pushing the system beyond its capacity, it starts to fail in very weird ways that people did not anticipate. And it'll happen again, because our system is not going to get any less complex, because it's not just regulated exchanges. No. Our market network consists of regulated equity exchanges, futures exchanges, options exchanges, automated trading systems, ECNs, data vendors, analytics providers, technology providers, the media. We've got the payment system, the banks. We've got an enormous number of interconnected institutions that are part of our networks. We've got liquidity providers, we've got liquidity takers, we've got investors, it's a huge network. You see, the market is not a single exchange. It's not what you see in the 6 o'clock news where, some guy's ringing a bell on an ancient trading floor. No. Just as Sun Microsystems used to go around saying that the network is the computer, we must never forget that the network is the market. And what happened on May 6th was it was under tremendous volume stress as a result of all the news about what was going on in Greece. At one time, the CME was trading 1,000 contracts per second in the E-mini alone. Remember, the E-mini represents a basket of 500 stocks. There are numerous media reports of systems problems at various places, of data problems, latency issues. Now, that may not sound like much, and indeed, to the regulators in Washington, they don't grasp the significance of this. But, our markets are computerized markets. The old days when Billy would trade with Vinny, long gone. Now it's my computer trades with your computer. And in order to trade, we need to have good data. We need to know the machines are working properly. We need to know that when we send the order into the exchange, it's going to be treated fairly and come back to us in the timely manner we expect. Well, guess what? The market was under such heavy volume that the system started to become undependable. The NYSE Arca exchange had serious problems, so serious that the other exchanges said, hey, we're going to declare self-help and kind of ignore you while you get your act together. Now, under normal conditions, stuff like that happens all the time because, as in many networks, there's a certain amount of redundancy here. And most of the time it works really great. If one exchange has a problem, everybody else just trades right around them. It's so routine, it never makes the media. But when the system was at capacity, suddenly these data problems at various key networks and key nodes in the network started to cause problems. And what it did, and again, there are media reports that several major firms stepped to the sidelines. After all, that makes a lot of sense. If you're a computerized trader and the computer starts acting up, if you don't know if your trade is going to be processed, if you don't know that you're going to get a response in time, you do the only rational thing, which is you turn your computer off until the system settles down. And that's what a couple of firms did. But you know what? Those firms were the ones who provide a lot of the stability and liquidity in the market. There have always been investors who try to buy on the dip, sell on the rebound. That's a stabilizing force in the market. Market making is like that too. It's a stabilizing force. So we had the exchange computer still running, but the stabilizer part of the network was pushed to the sidelines by the data problems. Well, so what we had was a partial failure of our network that caused a chaotically unstable situation. There's no smoking gun, just smoking computers. Now, what really frightens me is not that glitch occurred. In my comment letter in the concept release, that was put on the web roughly a week before the flash crash, I basically warned that, hey, our markets were vulnerable to this kind of thing. The SEC needed to take care of it. So the fact that, under super heavy volume, things started to fail should not really be a surprise. What's frightening to me is the regulatory misunderstanding of what went on. If you look at the preliminary report of the SEC and the CFTC, their first finding is like, wow, the equity market and the derivative markets are linked together. This was news to them because you have these separate regulatory bureaucracies that don't talk to each other. And they spend all this time looking for the smoking gun and ignoring the smoking computers. So what it really demonstrated was, how poorly our regulators understand the market that they're regulating. They literally are in another world in Washington, and it's not going to get any better anytime soon. So, with that optimistic, upbeat comment, I'll turn it back over to the moderator.
Thank you very much, James, and thanks, Eran and Eric, for your comments. Since we are now on the topic of the flash crash of May 6th, and we got James' opinion, do any one of you want to add anything to that? Do we have agreement on what James just laid forth? Or do you have the additional comments or thoughts?
Yeah, and some of this is, a little bit of inside baseball, what's going on. I mean, the SEC has come to my exchange with something equivalent to 6 different significant data requests formulated in different ways for all the data that related to that day. And I think there must be a law out there that with each data request, the probabilities of them actually putting together exactly what happened is probably diminishing. Because it's an enormous amount of data that they're trying to compile, and it's in an environment where there's a lot of signals. In other words, there was a lot of instability in the market. There was a confluence of events, and it's like walking into a room where all the knives are falling from the ceiling and saying which one hits the victim first. You can't really identify what was a leading event when you have so much going on. And I think even Mary Shapiro in her testimony before the House said, that we may learn that it's a confluence of events that taken together was exacerbated by a down day, and that's what I think they're going to find. And people talk about what happened. Should the machines, the high-frequency traders, should they have more requirements to be there? There's sort of this notion that machines should have been there, but humans maybe not. But the fact of the matter is, machines are programmed by humans, and nobody wants to be steamrolled in a market that's by a steamroller that's out of control. If the machines don't understand the signals that the markets are giving, or there's too many signals for them to actually formulate which way the market's going to go, they're going to unplug, or they're not going to engage in the same way that in 1987 a lot of hands went down on the trading floor because people weren't going to engage in a market where they couldn't predict where it was going. And I think, basically what happened is the machines may have magnified the acceleration of that event, but they didn't cause it. They just allowed it to occur more quickly.
Thank you, Eric. Eran?
Well, I think they summarized it perfectly. The only thing maybe that I can add, if you just look at the volume during that day, you would see that until something like 2 o'clock, the volume was basically as predicted by ADV and the U-curve that we're all familiar with, but there was a huge amount of volume starting at around 2. And between 2 and 2:40, we already traded the amount of volume that was traded during the first 4.5 hours of the day. And exactly this is what happened. The market simply, at least my belief, collapsed under the pressure of so much volume and people could not absorb it yet. It could be just that a lot of market makers had a lot of inventory, on the long side, people were selling, and eventually people that usually supply liquidity reach their risk tolerance and step out. And once that happened, that the market collapsed. But they basically step out because for half an hour they basically bought and bought and bought until all their risk silos were basically maxed out. So this is something that could happen if there is a lot of seller in the market. That's what will occur eventually. It's just that today there is all this market maker that can absorb this liquidity for a relatively long period of time until they will throw the towel like any other investor, and then that's what happened, one big free fall.
So I think a sort of a follow-up question to this, and you've sort of alluded to this. What are the things that we should do going forward to prevent something like this to happen again? And are the things that are now being put into place, we're talking about trading halts and circuit breakers and so forth, are that going to prevent this from happening again? Or are there other things we should be looking at? And maybe in addition to that, I'd like to add the question about the regulatory framework. Are there issues there that needs to be addressed as well?
Well, I guess, you know, how many of you have read or are familiar with the black swan theory? We got more black swan than we got for high-frequency traders, right? And certainly, except for the one who was engaged in predatory trading. You know, I think aside from the circuit breakers, single-stock circuit breakers, which I think do make sense, I think there is a real risk that we have a black swan event going on here. In other words, we may focus so much attention on this single day, on what occurred, and trying to prevent it, that we may overreach, we may oversolve. There may be ramifications on trading that aren't being thoroughly thought through. When you sort of, you know, jam a lot of regulations within a short period of time, there's always a risk that you're going to get it wrong, and you're going to solve for problems that don't exist and create new ones in the process. So that's one of the things that concerns me when we talk about, you know, 10% across all stocks. I mean, that's just nuts. I mean, I look at things like that and I just say, you know, we've lost our mind, and basically it's agenda pursuing. It's an opportunity for certain enterprises that have a competitive interest in the direction of, you know, and where the regulation goes, to position themselves to be beneficiaries without regard to the broader implications for the market. I mean, when it comes to things like dark liquidity, you know, for example, DirectEdge has always been a supporter of dark liquidity in the market, and we think a lot of the concerns are overblown. We think that there isn't a problem, but yet there are some who have in the displayed market, we're a displayed market, but think, you know, a non-displayed market is a threat. So if we can eliminate the threat of the non-displayed market, right, then we can increase more flow to the displayed market. The point being is that, you know, when there's dramatic change like this, it provides an opportunity for some with underlying agendas to try to force things that may not necessarily be beneficial to the market, and others just get confused in the process and perhaps overreach.
James?
This is a business where the devil is in the details. And I've actually been pushing for stock-by-stock circuit breakers for over a year. If you look at every automated exchange around the world, almost every one has some kind of last-ditch stopgap for when something goes dreadfully wrong, you stop trading. I mean, to me, having that kind of a circuit breaker is just common sense. That, yes, individual actors have all the right incentives to make sure they don't make the big trading mistake. But you know what? Mistakes do happen. Crashes do happen. You know, everybody involved in flying an airplane has all the right incentives to make sure that it doesn't crash. But every once in a while one does, and we need to be prepared for it. And, you know, the idea that when something goes dreadfully amok, you pause for a few minutes to make sure that your systems can work and everything else is okay, to me is just plain common sense. But the devil is in the details. You know, so for example, you know, the pilot right now, it doesn't cover the first 15 minutes or the last 15 minutes of trading, the most volatile time in the entire day. Excuse me. You know, what is going to trigger the pilot? What's going to trigger the halt? We had the very first halt the other day, and it, this is the Washington Post company of all people, and it was a trade a couple $100 away from the previous price. Now, I'm wondering what kind of an exchange accepts orders a couple $100 away from the previous price. And indeed, there was a latency in how the circuit breaker kicked in, so that it wasn't just one trade that got through, it was several that got through before they finally shut things down. So there are a lot of issues in the details of how this thing actually gets implemented. But also, I want to get really careful about language here. We like to use really colorful language in this business, but we know what we're talking about when we talk about a dark pool. But you know how that plays in Peoria? It sounds like something Darth Vader invented. Okay, so indeed, to the common person on the street who has a lot of political clout and who writes tons of complaints to the SEC, that today's financial markets are a place where it appears to them that these high-frequency traders are cavorting in dark pools while they're flashing Aunt Sally's orders to the people engaged in naked access. I mean, it just sounds dirty. So as an industry, we really do need to watch our language and come up with better displays. I like targeted pools, where you target the display of your information, because dark pools are not really dark. The moment that trade takes place, the flash bulb goes off, and we have 100% instant post-trade transparency. And also things like so-called predatory orders. This is something people have been doing for hundreds of years, watching the information in the market, trying to figure out which way prices are going, and position themselves accordingly. Every time, because we have such great transparency, every time an institution trades a little piece of a big block order, that information is instantly revealed to the world. And guess what? There are a lot of people out there who are pretty skilled at looking at those little pieces of information, putting the pieces of the puzzle together, and trading accordingly. Well, that's a result of the transparency we've got. To call that predatory, I call that good pattern recognition. And if an institutional trader is going to be so sloppy in their trade execution that this is a problem, I think they need to pay more attention to how they execute their trades. And if they don't like the fact that when every time a child order of their big block gets executed, then they should choose other order placement strategies so that they're not following that approach.
Thank you, James. So the language and the terminology is, of course, very, very important. But another take on this, of course, is to say, look at the broader question that an economist would ask and say, what is the economic value of high-frequency trading to society? Is there a measurable value of increasing the speed or increasing the frequency by a millisecond or a microsecond? So what are your thoughts about that? What is the economic value here to society, and how do we explain this to broader society, that this is something that's here to stay and that is valuable?
The economic value is huge. And again, this is something the average person doesn't understand. They go, whoa, these people buy and sell, they don't want to hold overnight. How can that be of value? These are the people who smooth out trading, that they serve a purpose. Just like a used car dealer serves a purpose. You want to go sell your used car, they'll buy it from you at the bid, and then they'll turn around and sell it at the offer. They provide smoothness, they provide liquidity. The used car dealer doesn't really want to, drive your car home at the end of the day. No, he wants to flip it. But they're providing a service to society. If you look quantitatively at the quality of our capital markets, by every measurable dimension, they are far better now than they were 10 years ago. Bid-ask spreads have collapsed. Commissions have collapsed. Execution speed has increased. Visible depth in the markets has jumped dramatically. So by any measurable dimension, our markets are far better than they ever were before. And yeah, there are people who trade fast because a lot of the strategies they follow are pretty simple strategies, and they need to jump on them fast before somebody else does. But that's competition. And when you look at the results, most of the time, our markets work far better than they did a decade ago. Now, May 6th was not caused by too many high-frequency traders. Au contraire, it was caused by too few. We saw what happened when a few of the high-frequency shops got pushed to the sidelines by the system problems. So, as far as I'm concerned, the high-frequency traders are really a great benefit to our markets. Mostly they're doing, as was mentioned, what people have been doing for a long time. Buying in the bid, selling in the offer, engaging in arbitrage strategies to keep prices linked between the cash markets and the derivatives. Yes, they're trying to harvest information. Some of them go to the scrape news feeds, public information, to try to figure out what it means. These all help the markets function that much better. And yeah, there are people who try to play games around things like stock exchange rebates and things like that. But you know what? People have been playing games in financial markets since in the equity markets especially, since they began 400 years ago in Amsterdam. If you read historical treatises of the games that were played then, they sound a lot like the games now. People are very clever, very creative. They will use whatever tools are available to try to get an edge, to try to get an advantage. And high-speed computer technology is just part of that. But it's really gotten a bad rap. There's a false meme going around that says, "Ooh, these high-frequency traders get an advance peek at the institution's order book." That is just simply not true. An institution, when they go to trade a large block, they have a lot of control over how they expose that order. It's not as if the predatory hedge fund high-frequency shop is going to use their computer to secretly spy upon somebody else's order. No exchange or broker-dealer would stay in business 5 minutes if they were leaking information in a way that was not approved by the person putting in the order.
Ron, you had some comments.
I want to take a little bit of a different approach for the benefit of high-frequency society of trader. I agree that high-frequency trading has some benefit, and I will touch on them. But before I do that, I want to suggest everyone go home and on Monday morning do the following experiment. Go to your favorite OMS and put 10,000 share IBM VWAP to buy and 10,000 share IBM VWAP to sell. Run them for the full day. Do you think that on the end of the day you will be at 0, plus or minus? Who thinks you're going to be actually plus? We're going to think that you're going to be negative. You're going to have a negative P&L. So basically, most of you will have negative P&L, and this is exactly the tax that you're paying for high-frequency trading. You had a very, very patient strategy. 10,000 shares of IBM is no-brainer, and there is no information leakage here because you cancel it by putting an order on opposite side, so you didn't glean any information to the market. So basically this negative P&L that most of you are going to have is exactly the average tax that high-frequency trading collect. And it collected it although you didn't need their services. And that's the main issue where high-frequency do not benefit society. If you have all the people in the world who are patient investors or patient traders, let's call it something like patient trader because it's the right phrase, then what really happened in the world, they would meet each other. Both of them will trade some sort of a VWAP. So half of the time you're going to cross the spread, half of the time you're going to collect the spread, so on average you're going to execute VWAP. And this is exactly the point with what high-frequency trader, that you cannot opt out from interacting with them. Even if you don't need their service, they bridge liquidity, that's great, they supply liquidity. But if I trade every 3 minutes, I don't need their services in any way, shape, or form. Now, where they actually benefit society, in some respect, if you look at how buy-side traders trade, it goes that between 30 to 50%, depending who you ask, depending what is the day of the week or the month, 30 to 50% is executing via super-duper aggressive algorithm. Fan, Gorilla, there are some other Vapor, Spider, I don't know, I lost track of all these names, but huge amount of investor trading is done via these super aggressive algorithms. And this is where the high-frequency trader actually provide a benefit. They step in, they say the guy has no idea what he's doing, he's trading like, forget me for the term, maniac, so irrational. Let me step in and provide him liquidity, and they basically reduce the cost of trading in such an aggressive way. But the problem with them is that when they are not needed, when people trade patiently, when people want to trade with each other, one buy-side trader want to sell 1 million share of Dell and another one want to buy, in the current market environment, because these high-frequency traders supposedly has the fastest machine, they will reach first to the queue, you will be second, and you will be more exposed to adverse selection. And this is, again, this is where dark pools start to provide some relief from this guy. But overall, if people or buy-side trader would have been more patient with each other, basically the model that high-frequency trader operate at will to some extent go away, because they will be able to trade each other instead of having the need of Getco, Knight, or any other of this high-frequency trader to bridge this liquidity demand. So it's not high frequency are good in any way, shape, or form to society. They're good in very specific case to provide liquidity when no one else is there. But again, the flip side is that you cannot opt. It's very hard to opt out from interacting with them when you're actually trading patiently. You want to provide liquidity. And exactly the experiment that I described earlier basically demonstrate trading patiently, you still pay a tax. And this is exactly what we want to avoid. What we really, a perfect capital market will be when someone actually use two VWAP on opposing side. At the end of the day, will be exactly at zero. This means that information cancel each other.
So I want to move on here, because we have about 5 minutes left before the reception. So during this time, we'll take some questions from the audience. This gentleman over here.
This question is mainly for Iran. You talk about dark pools, and you talk about someone taking their 200,000 shares and not showing it in the market and just putting it in a dark pool. Aren't you distorting the price by not showing it in the market? So then when the participants actually trade in the dark pool, yes, they're getting the MBBO, but that MBBO would have been a different MBBO had they actually shown their pieces. And as far as your, if I may, I'm just going to continue a little bit. If you take your VWAP experiment and you do it in your dark pool, you would think that you actually came out with a zero P&L, but you didn't, because you have to pay the dark pool provider, you have to pay your clearing firm, you have all other kind of costs that are involved there. If you actually go into the market and you have a smart VWAP algorithm, you're actually going to make money, as opposed to just coming out, at some midpoint of your buy and your sell.
Okay, so let me try to address this question one at a time. So first of all, what the gentleman asked is, if someone has 200,000 block resting in large block dark pool, he distort basically the prices. Now, two people I put 200,000 in my big block dark pool and I'm executed. So obviously, if that's basically cancel the information that, you cannot, and there was another person that had exactly the opposite order, and our information basically canceled each other. No, there is no information except temporary impact that would have been created if we traded in the open market. If both of us traded into open market, basically what would have happened, both of us would have incurred temporary impact, but permanent impact would not have been, because exactly they would cancel each other. So as long as there is a trade, there is no distortion for the price discovery. If there is no trade, suppose I'm putting my 200,000 IBM in my big block dark pool, and after 2 hours it's not executed and I need to be done by the end of the day, I will start to rip pieces and trade out. And there are optimal ways to do that, and I will incur some impact, some temporary, some permanent, in a way that it's basically minimize between the opportunity that someone else will come on the other side. So no, I don't agree that it distorts the price discovery because if there is a trade, it cancels each other, and if there is not a trade, this 200,000 will appear at the market, and permanent impact will be created from this 200,000. Peter, want to say something?
Since we're starting to run out of time here, let's take a question from this side. Any questions here? A question over here.
I understand how in the old specialist system there was a bid-ask spread and the market makers got to capture that. And the catch was that at the end of the day they had to be the liquidity provider of last resort. And not being an equity guy, what I don't understand is who is that today, and does that even make sense in today's market?
Yeah, well, first of all, I think the liquidity provision of yesteryear is often overemphasized. I mean, the fact of the matter is that no market maker or specialist ever had an obligation to provide liquidity more than 10 to 15% of the time. Even today, with the DMMs on the NYSE, 15% at most of the time you have to be there, and there's no requirement for what price you have to be at. So the notion that there was ever a time where a specialist had to like lay in front of the steamroller and get crushed when the market was going crazy, that never existed. It's really something that people rely on and say, well, what about back then? The only thing I will say is that in the markets of yesteryear, you had and I'm not saying that this was the preferred model, but it's a reality, is that you often had the listed market was also the issuing market, so there may have been more of a more pressure internally that if you have an issuer and the stock is getting rammed, that maybe the specialist should step in, but there never was a requirement, and I think from discussions I've had over the years with various specialists, when the markets were going crazy, they would generally minimize their risk. I mean, and depending on the issuer and the politics, it might be a little different, but it was far from being a system that worked sort of seamlessly absent that.
Okay, we'll take a question here.
Yes. I like the way you distinguish traders that are stabilizing versus traders that are destabilizing. Basically, traders are precisely stabilizing because they buy low and they sell high. And what is destabilizing is when, on the contrary, you sell low and you buy high when you're following the trend. In fact, the truth is that precisely high frequency trader may be one and the other at the same time because of the stop losses. And that's precisely what happens. You see, whether the stop loss occurs with you shut down the computer or because it's pre-programmed in the software that after a certain loss you stop the loss, you are in a piece of the software, piece of the dynamic that is destabilizing. And the vicious aspect of accelerating time is the fact that you have a basin of attraction of the equilibrium, which is when you go switch from this attractive behavior to the repulsive behavior, and the edge of this is narrowed by the acceleration of the frequency. So, talking words, black swan is a word. When you say this is a black swan, you don't say anything if you don't say what is a black swan. And in here, we can call a black swan precisely those trades that, in fact, that go out, that put you out of the basin of attraction of the equilibrium price, and that pushes you away, where information, where in fact the seek for information is wrongly taken from information, then you destabilize. That's what we see as a spike, and it's probably what happened on the 6th of May. And the question now is how to optimize the stability. What actions you could do on high frequency trading to optimize the stability.
So how to optimize the stability? Who wants to address that question?
Well, I would submit that I think the single stock circuit breaker is probably, if constructed correctly, I mean, we're going down the road, right? So it's at this point, mine is one of acceptance. But if constructed correctly, either circuit breakers or even potentially some other device that would provide the collars, that is going to be what stabilizes it. Whether or not it has ramifications for the rest of the market is another matter. But you are going to get some more stabilization.
We had a question back here, the gentleman with glasses.
That's me?
I guess there are two
A lot of questions.
gentlemen with
Go ahead.
glasses.
Go ahead. I'll take the first set of
The
glasses.
nicer gentleman, yes.
Okay.
Thank you, Peter. Thank you, Peter.
So, for James, the problem really is that we hit these capacity limits within the financial market, financial networks. Then shouldn't we really be looking at applying congestion control techniques rather than just these gross kind of secondary mechanisms of circuit breakers based on prices?
Control techniques, wow.
Amen, brother,
I know
on
what
that.
that means.
Yeah, I agree that something that can keep the network from overflowing its volume limits makes a lot of sense. The question is, how do we do that? Because the network is so complex. No one regulator regulates even a major fraction of the network. You've got so many different regulators involved, and the figuring out where the bottlenecks are is a complex task. So let's start with the fairly crude circuit breakers, which I think will go a long way to being exactly that. The pause on the CME, just 5 seconds, effectively converts the market from a continuous market to a call auction, and that tends to help find the balance of supply and demand. So I think we can get a lot of traction from fairly small tweaks like that before getting into trying to figure out where's the bottleneck in the whole network.
And we have time for one last question.
Thank you. Can you hear me? Very good. Anyway, you've spoken in favor of single stock circuit breakers, but I can imagine that the existence of the regulation might exacerbate the problem. Like something moving 8% down and so you sell. Could you generally speak about potential unintended consequences of single stock circuit breakers?
What are some of the problems with single stock circuit breakers?
Well, I alluded to it before. So if I'm a market maker and I know that I might not be able to get out of my hedge, right? So I'm a market maker. I have my hedge. I have two sides of it. What if I do one side and the market maker trips before I can do the other side, right? So now I'm stuck. I'm holding a position. I can't do anything with it. Now the market moves after like 5 minutes. Now how do I manage out of that issue? And I think that's a problem with clearly erroneous, the clearly erroneous thresholds too, because you could be broken, and now what do you do? So I mean that's one that's a very strong consequence. The other one is to the extent these markets are interlinked, it could also create complications as you try to hedge across asset classes.
Yeah, this is why we need to pilot this. We need to experiment with different stuff. And the problem is we're never really going to know how well it works until the next May 6th macroeconomic day hits. So that because as the market evolves, it's a complex network, and the bottlenecks will show up in different places, and we'll probably have lots of unanticipated interactions between all of these different attempts to corral volatility. So you're right, it may well be. What happens when 1,000 of these trip at the same time? Will that news event cause people to panic even more?
And I was having a conversation with an unknown bulge bracket firm. They were talking about when the Washington Post tripped the other day, and they said, it was pandemonium. Nobody knew how to react. Customers were trying to adjust their orders. We didn't know what to do. It's like, wow. That's why it actually should be shorter, so you're not thinking about how to react. So it's just liquidity pooling. But now it's like, it's a new trading environment. How do I position my order? Some people say it should be longer. What, do you want like a positioning market for 10 minutes? You just have orders lining up, and that's a whole new dynamic in the market, which is why I think circuit breakers at 5 and 10 minutes don't work. You cannot have circuit breakers for that long. You have to there has to be another method. Some people would say limit up, limit down. I would say just keep the circuit breakers super short. But short of that, I'd say limit up, limit down. I don't know. It might be worth exploring, but slowly and carefully.
And on that note, we need to close. And I'd like to thank the panelists here. Thank you very much.
And don't forget that we have after-hours liquidity to enjoy.
Every client wants something else.
Drinks will be right outside here. Thank you, and have a good summer.
Every client?